All right, we are live. Hello and welcome to the Financial Advocacy Podcast. I am your host, David Kinder, registered financial consultant, chartered life underwriter, with my co-hosts, Kurt Gibbs and Mike Moffat. Today, we are talking about the lazy advice surrounding, I believe, qualified plans. This is a fun topic. We got all the other subjects in line out of the way so we could get ready for this one. This one is kind of a big deal, and I'm kind of starting off with the fact that I believe that the financial services industry, we love lazy advice. We like having our mantras without having to think too hard about them. Uh, and that's why we keep hearing so many of the same things over and over and over again. I'm like, have you ever thought about that? Have you ever done the math on? That's always a great question to ask, by the way. Have you ever done the math on that? Uh, there's so many different things, and so one of the biggest ones was, especially surrounding these qualified plans. I say that in quotes because the IRS, in order to make it a qualified plan, you have a lot of hoops to jump through. We're going to figure out, are those hoops worth it? Really, should the American people, do they understand how all these things work? And I'm convinced that most people are, unfortunately, more clueless now than ever before. And that doesn't mean that that's just because we've elevated our knowledge. It's because they just don't know. So the biggest piece of lazy advice I want to start off with is that you're going to retire at a lower tax bracket. Now, Kurt and Mike, you guys have heard that.
Mm-hmm.
What have what are your thoughts before we dive deeper into that one?
Well, on the surface, it sounds true, right? Because in retirement, in theory, you may or may not need less income to live on. Well, yes and no. That depends on a lot of various factors, such as inflation. Also, you're not taking into account tax rates and other various things, or medical expenses, or different things that might come up. So you're not. The picture isn't as totally clear as a lot of people like to make it sound, where you'll necessarily need less income to live on in retirement. Maybe not. That really depends. I think that the issue, though, is that who wants to live on less money, right? I mean, you worked your whole life to build this huge account, supposedly huge account, and now you have to live on less in retirement. I don't understand why you would want to live on less and have less of a lifestyle now that you've worked your whole life to retire and to build this, amount of money, when that's what you've tried to accomplish your whole life, is to retire comfortably so you can enjoy it and have fun and do all the things that you need to do and, take care of yourself and whatever. So I think it's at least partially lazy advice, for the fact that people don't always necessarily take into account all the expenses and ongoing things and cost of living and medical bills, all the different things associated with that come into place. So, it sounds like a nice mantra. Oh, you'll need less money in retirement. Well, when you do the math, that may or may not, in reality, be actually true.
Yeah, you're exactly right, Mike. It goes back to really kind of what you said in your opening statement. We've done the math, and you're going to need more income than you realize in retirement. First of all, simply because the time we live in now, things are obviously a lot more expensive, and different things that are going on. But I think the big thing that you kind of touched on is, you did, Mike, is it's just in theory it sounds good, and it does, and you have so many things that come into play when you're talking about the word income. What is really income? I mean, how is it described? How is it, what is the really meaning behind what, income? It's how the tax code treats it, and how we can show you a different method to have more with less, I think is the big picture.
Well, and here's the thing, you think about it currently. If you're struggling to pay your bills, or if you're, exceeding your costs while you're building that account, but then you're expected to retire with less than you're currently bringing in, how does that make sense? And especially if, as you're approaching retirement, if you're struggling to still, make ends meet or do different things, I don't understand the math, how all of a sudden people can tell you that, oh, well, you need less money when you're in retirement. Well, sorry, that the math doesn't necessarily work. If you need the money you're currently making now just to live, how are you going to live on less? I mean, what are you going to do? Sell your house or something? So you know, and then downsize maybe so you have a little bit more money. You know, the like we said last week, the math ain't mathing.
No, and you know the other thing is once again the industry teaches and puts out information that's not necessarily true. And in fact, I'll say that none of it's true when it comes to a couple of the statements that I've heard just recently in the last 3 to 4 months. And I think we had another member of our group that actually had this personally happen with him. Is they meet with an advisor and they talk about retirement, and they're within a few months or a year, and their approach is that well, you're going to be in a lower tax bracket. Well, why do you want to be in that lower tax bracket? Don't you want to be in the highest tax bracket, but pay the least amount of income on those taxes that are associated with the bracket you're in? I think that's
Exactly.
it's such false, it's horrible information that's passed on. I was in a local Starbucks just a few months ago, and had an advisor for a large firm that we're all familiar with, that are pretty much 4 or 5 of them in every town that you pop into. Green logo, we know who they are, but their approach was, you're going to be in a lower tax bracket. And I'm sitting there listening to this and this conversation, and it just blows me away that's what the industry is putting out there, that yeah, you're going to be in a lower tax bracket, and that's what you need to understand, that you're going to have to live on a lot less income than you're accustomed to during your working years, and it doesn't have to be that way.
No, and you both brought up a few points that brought some things to my mind. So the first part is, do we need less income in retirement? And it reminded me of what Tom Hegna talks about, and he's of course PBS speaker, author, and presenter. He talks about the go-go years, the slow-go years, and then the no-go years. And the go-go years are you're freshly retired. Every day is Saturday. You're going to go out and you're going to have some fun. You need to enjoy your retirement, and I'm all for that. But that stage lasts a few years, and then you're going to slow down a little bit. And at that point, it's also at that point you might need some long-term care possibilities and such. And then you got the no-go years, which is you're just, that's really when we're thinking about the rocking chair on the porch. That's that kind of time, and really you're kind of counting down your days, which is really grim to think about. But then, Mike, you brought up the other part, which is if you're having hard time and you're struggling now, how are you able to put enough money aside? And that reminded me of an article, I think it was like 5 years ago in Forbes, where because of credit card debt, less people were contributing to their 401ks. And that also brings up another part, which is when certain disasters happen, the government, in their infinite wisdom and generosity,
Yes.
allows you to get access to your 401k because you were affected by, let's say, Hurricane Katrina or whatever other disaster. Say, hey, you can access your money now without penalty. Ooh, thank you so much, federal government. Will they just leave us alone? But they won't. But anyway, that's a whole nother rant. But the thing is that you think it's your money. It's really not. There's so many other things that are tied into that. But in a way, at one time, that saying that you'll retire at a lower tax bracket, at one time that was true. And that was probably back when the 401k was first created.
Mm-hmm.
So we got to go back in time a little bit. ERISA, which is, and I never remember the acronym, but it's Employee Retirement Security Act of 1974. I had to look that up and write it down because I never remember what it is. But that was the act that created the opportunity for 401k plans. And Ted Banna, however you say his name, he's the one that created the 401k, kind of discovered it, helped build it out. And in 1978, we had our first 401k plans, which were meant to be supplemental to pension plans.
Mm-hmm.
So we got to talk about the two differences on that. Pension plans are defined benefit plans, which means if you work for a company for X number of years and you earn so much, you're going to get a benefit of whatever it is because you satisfied years of service, etc.
It's it's basically like a guaranteed income lifetime annuity.
Yeah, it's exactly that. And the thing is that was fully paid for and defined benefit by the company you work for. With 401k plans, it's literally called a defined contribution plan. There isn't a defined benefit, but you can contribute and take ownership, good, bad, or indifferent, for your future retirement security. So what I'm going to do here real quick is I'm going to share my screen because I have the spreadsheet from the IRS itself, and I put that in the link in the video description below, so you can tell that I didn't make anything up here. The only thing I did do was I highlighted a few cells here just to make sure I keep myself straight here. But this is a spreadsheet from the IRS of the historical lowest and highest tax brackets. And so we could go all the way back to 1913 when the income tax became the law of the land. But I'm going to go forward up here to the 70s. And in the 70s, our top tax bracket was essentially 70%. And so if you were a top earner and you were able to defer more income at that 70% part, you'd have to think, well, gee, is it likely I'll probably retire at a lower bracket? Well, when you're contributing at 70%, the answer is probably yes. Probably. And so I believe that at that point, it made a whole lot of sense. But then what happened? Well, 1980 election year, who got elected? We had Reagan elected. And when Reagan got elected, eventually, top tax brackets went down. So eventually went from 1980 was 70, and 82 went down to 50%. And then a few years later, and we'll know it's the Tax Act of 1986 was almost a complete overhaul of the tax code. And then if we look here, 1988, it went down to as low as 28%. That's now the highest tax bracket. So we went from the 70% down to 28%. Now, if you deferred back then, that's great. But are we rethinking making deferrals at 28% when it used to be 70%? Well, at that point, we're still thinking, hey, you're going to still retire at a lower tax bracket. How much lower do you want when you were at 70 and now you're at 28?
Yeah, I mean, it's just, those are facts. And David, I'm assuming, just for clarification, that's an IRS publication you've got there, correct?
Yeah, and I put the IRS link where anybody can go and download it. The only thing I did was highlight the cells. That's it.
Yeah, I mean, so for those out there watching or that subscribe and watch later, I mean, that's not fabricated numbers there. That's been that's a timeline of events on really taxation and how it's probably affected maybe you personally or a parent or someone that has contributed to plans and the tax has done what to their nest egg or their retirement, what it's done at different phases throughout, our history. And as you mentioned, our presidents that were in office at the time. So it's just qualified plans. There's a lot more to understand. I think that people don't understand. I think they have just been handed it off from plan administrators, that kind of just say, sign up here. You want to sign up and contribute to your 401k. And we could take a little of our grandparents' advice probably and use a lot more common sense to the approach with money and qualified plans than what we probably have done in the past. As we all know, we can show you ways that qualified plans, as you put it earlier, the math ain't mathing.
Well, and I don't think anybody, again, like I've said many times on the show, is doing anything intentionally to harm people, or people aren't necessarily putting themselves in harm's way intentionally. I think the problem is that most people haven't really sat down and thought about, will I really be in a lower tax bracket? What exactly does that mean? And how would I have to be there? So when it sounds nice on the surface, and it's been a mantra that's been repeated, like you've said, for so long, for the last, 50 years now, basically, that it sounds good on the surface. And when you first think about it, you're like, oh yeah, that sounds nice. And that looks like it's true. The problem is that people don't really do the math or run the numbers to see that, it can't really be true, especially, if inflation keeps going and you have to, have more money to retire. There's no way you can possibly retire on less income. It just, the math, it doesn't add up. And not only that, we have how many trillions in debt now? You would think that at some point the tax have to go up to pay the debt, or they have to do something to start paying the debt. So in reality, is delaying taxes now, necessarily a good idea. And I think we've run some numbers on this before, and we actually can show it mathematically how you're paying a lot less, you're deferring a lot less taxes now to pay a tax on a much higher amount at an unknown tax rate in the future. So you're not really ahead at all, and in fact, you're probably going to end up in a higher tax bracket, certainly if things continue the way that they are.
Well, and the other point I think that we all need to take a hard look at is, for the average person that sees a qualified plan as a way of, their retirement and their nest egg. Uh, there's so much there's so much from our perspective that needs to be given to prospective clients about the education and how these plans were not set up for you as the contributor to be your nest egg. They were never really intended to do that. And now when you see all this volatility with the market, and the market's been crazy up, good for X amount of time, but for those that were in their mid 30s, let's say in 2008, that have been contributing maximum amounts allowable by our IRS rules to contribute to qualified plans, and 2008 was devastating. I'm a living proof of that. 35% of what you've accumulated in a qualified retirement plan gone, just vanished in a short period of time. And you really never recover from that. And if you do recover from that, you've got to take into account the taxation that back to the chart here, tax rates at one particular time frame or 10-year period, for instance, of your life compared to the last 10 years of your life. You put it in at one rate and you're going to have to take it out at a different rate. The saying that we have, the deferred, deduct, deduct. It's not. It's not a retirement plan. I would argue that with anyone.
Imagine if you were the person that had built all this wealth in a tax deferred account and then retired in 2008.
Yeah, I had some folks that fell into that trap, if you will.
And that's why the day, the year, the month that you retire is more important than the retirement vehicle that you're in. Because if you had retired, prior to that, you'd probably be okay. But, even if you're in retirement during that time in 2008, it took a long time for the market to recover. And now you're having to draw down money out of that account continuously, even while it's going back up. It takes a long time. What is it? To make up a 35%, correction into your account while you're still withdrawing funds from it and paying taxes on those withdrawals. So
yeah, I mean, it's a double-edged sword that is just a bad plan. A saying that I have is, the traditional financial planning is an illusion and it's a failure to the American taxpayer, and we can prove that. It doesn't get very complicated. It doesn't take a long time to show that the proof of how the math works out with qualified plans is not in your best interest. And it's jobs that we have as if you want to talk about fiduciaries, that should be your fiduciary right. You should be out there advocating for what's best for your client with proof. And the proof is that qualified plans are not your best route for accumulating wealth, and especially not spending it.
So let's do a little bit of math here, because you guys touched on a lot of things that I wasn't planning on talking about, but there's so many areas, and that's why this to me is this is just the introduction of this whole topic, and eventually we'll get into some other rabbit holes down the line, I'm sure. But let's suppose that you are a high earning professional or business owner. It has to be a business owner, and you want to put $1 million into a pension plan. So we're not even talking about 401k. We're talking about you're setting up your own pension plan. You're putting $1 million in. And if we did it at December 31st, 1990, you would have deferred $280,000, assuming a flat tax salary deduction or salary reduction, because it's really a salary postponement plan, but we're not going to get too much into that right now. But let's suppose that you decide, you know what, December 31st, I did it. January 1st the next year, oops, I changed my mind. You changed your mind. You want to pull all your money back out. Guess what? The next year, the tax rates went up to 31% instead of 28%. So instead of just deferring 280, you have to pull it out and you're paying 310. That's a $30,000 difference because you changed your mind. Now, granted, any advisor that was doing this for you is like, are you sure you really want to do that? They would tell you, you deferred it at that. This is what it is now. Was that disclosed up front? Did they even know that that was a possibility? I think somehow some people think that the money you put in, somehow it gets tracked by the year of the contribution, and somehow you get to pay the taxes back as of that year, and you just don't have to pay it now. And that's not how these plans work at all. So that's if you did again $1 million in 1990, you would have deferred 280. If you withdrew it the next day, it would be 310. Now, if you waited 3 more years to 1993, it would have been 396,000 of tax over the 280 that you had saved from before. So it really is you're deferring the income to the tax code of the year that you make the withdrawal. And the problem is, what's that going to look like, right?
Yeah, how is that a good plan? I mean, you got to ask yourself those questions. If you're the best advocate for your own self when it comes to things like this is to do some homework on what you have and see if it aligns with what you believe and where you want to go with things, because I'm passionate about this because I lost a lot of money. As a qualified retirement contributor back in 2008, as did most people. Your defined pension plans have become a thing of the past. Very few of those even exist anymore with guaranteed payouts. And it's like I mentioned earlier, you could take a lesson from grandparents and even, maybe a generation even further that had a lot more common sense put into where they did things with their money. And I think we've gotten away from that. It's almost like, probably not a very good analogy, but it's like now everyone thinks you can't do anything without your cell phone, and you just depend on your cell phone. Well, now, we've come dependent on the government to do what they need to do for our retirement. So they develop these qualified plans, and they want you to put all the money that you can into them, and you're going to put it in at this tax rate, like you said, and pull it out at a different rate. Well, who's that really benefit? Think about that.
It's worse than that. It's an unknown tax rate on an unknown amount of money.
Yeah, that's exactly. And this is a chart. I just did this morning because back when I was a registered rep and I was working in a credit union and helping our credit union members with IRAs and 401k rollovers and such, I had this little bit of a, this is just kind of a napkin thing I would write out on a legal pad saying, but I didn't do it with this terminology. Today I would do it this way. You had your salary reduction plan contribution, and we call it that because that's what it's called in the IRS publication 560. When you're putting money in a 401k plan, it is a salary reduction plan. And so the 401k and the traditional IRA, you have your known deduction up front. Does that help much? Well, not really, but we'll figure out that math later. Now, it all grows tax deferred. You're not paying taxes on your growth, but you also don't get a capital gain, capital loss deduction either. The growth is whatever it is. But only out of those three, only the Roth IRA had a tax-free distribution. And whenever I would show that, everybody said, "Well, I want the deduction up front." But if I would have said, Mike, what you just said, which was you're trading a known tax deduction today for an unknown tax bracket in the future, how do you feel about that? You're in partnership with your wealth in this plan in an arrangement with the federal government. And that's literally what it is. It's an arrangement. If we look up IRS publication 590, the A in IRA does not stand for account. This is the biggest thing that most advisors miss because they just didn't think of it this way, and they don't realize that the IRS actually put it correctly. It's an individual retirement arrangement. Well, who created the arrangement? The federal government. Who gets to make the rules? Federal government. Who enforces it? The Internal Revenue Code and the IRS. Do you really want that arrangement?
Yeah, David, the thing too is back to, a little bit of how they've kind of pushed things, on us as taxpayers from a qualified retirement plan perspective. Let's say you're 18 years old and, let's say you're fresh out of college. You're 22, 23 years old, and you start contributing to your 401k. You've gone from basically being in a zero taxable bracket with your retirement plan to, as some of those radio hosts out there that want to say, you need to start contributing your 401k and you want to maximize that out. You're setting yourself up to be taxed with your retirement for the rest of your life, because that time frame from 18 to what it is currently at 59 and a half before you can have even access to it, if you can even get your hands on a portion of it, you're just handcuffing yourself from day one, straight out of school to your retirement plan until you're of old age. And obviously we advocate for a much better way, a much more solid way to accumulate money and to spend it. And it's frustrating for me as being on both sides of the fence to see how our government and how things come full circle without us really investigating all the avenues that are available to us to really have a better retirement and do more with less money.
Right. Well, you kind of hit the nail on the head, but you also, when you think about it, when you're 18, 23, or whatever, when you're young and you're making less money and you're basically in that 0% tax bracket, now not only that, but maybe you get married and you have kids, and now you have tax deductions on top of that. So now you're delaying taxes when you have the most deductions and you're in the lowest tax bracket that you'll ever probably be in when you're young, to a future time when you've accumulated more, hopefully, to pay at a much higher tax bracket in the future and at an unknown tax rate. How does delaying the tax make sense when you're already basically in the lowest tax bracket you're already ever going to be in your entire life?
Yeah, I mean, and the other thing too is, so many people now, especially as of late, are, I've got $1 million in my 401k. Well, do you really have $1 million in your 401k? You've got statement wealth, as we call it. That's what you have. You're statement wealthy. You don't have $1 million in your 401k. You've done just what you've talked about a couple of times here while we've been chatting about this. You've put it in at that unknown rate, and you're going to take it out at that unknown rate. So out of $1 million that your statement says that you have today, that could change tomorrow, as we well know. How much of that's really yours? How are you going to distribute that in the most advantageous way at retirement? How are you gonna make that work for you?
Right. Well, most people, you ask them, how much do you have in your IRA or your 401k? They'll say 500,000, $1 million. Well, have you ever tried? What would happen if you tried to surrender it? Especially if you're under 59 and a half. You don't really have whatever that number is. You have at best a third of it, and then if you're under 59 and a half, you have a 10% penalty on top of it. So, you don't really have whatever that number is you're thinking you have in your 401k or your tax deferred IRA. You really don't have that. You have a lot less than that. The money hasn't been taxed yet. It's not yours. And if the government decides to raise the tax rate to 80% tomorrow, they can do that. You've delayed paying the taxes on it.
It is literally held hostage by who we have this arrangement with. And so at this point, I want to play this video. This is Grant Cardone, and whether you're a fan of him or not, this is an interesting little clip. And by the way, he got a couple of details wrong, but it's interesting that the guy interviewing him says, I think he's got 2 or 3 million in a 401k, and he thought he could get at it tax-free. This is funny. Watch this.
A lot of money in my 401k.
Okay, I'm sorry for you.
Why do you feel sorry for him? It's a way to put money in without paying taxes on it.
It's a way for you to be trapped for 30 years.
Well, you can pull it out when you're
63. How old are you right now?
50.
13 years from now, will taxes be higher or lower?
Higher.
You will wish you would have sold them when you were 50 because you'd pay lower taxes, dude.
You don't pay any taxes when you pull out money out of your 401k if you wait until you're 63.
When you start using that money, you're going to pay taxes, bro. You weren't charged taxes while it sat there. What's wrong with you?
IRS allows penalty-free withdrawals from retirement accounts after the age of 59 and a half.
Penalty-free, not tax-free. So they're going to charge you a penalty. They're going to put handcuffs on you to sell it before then. But dude, when you're 63 years old, when you start withdrawing, you're going to start paying taxes at that point.
Yeah, you're right. 401k withdrawals are taxes in.
Exactly.
That was sad. Here's a person who's got, what do you say, a couple $1 million in his 401k, and he has no idea how it works. And by the way, it's not age 63. You can begin pulling money out at any time. The question is, can you do it penalty free or not? And that's the age 59 and a half. There's even the age 55 rule, but we don't need to get down that road here. But what we're really talking about is beginning your wealth and retirement planning with the end in mind. Because if we don't think about it with the end in mind, we're going to think, what can we get today? And today's mentality, when you're thinking about today, is how much money can I get? How big of a pile of money can I get? And can I take full advantage of my company's employee benefit programs? And so a lot of this comes from HR advice. It's not always from the accountant. It's always, traditional accountants are going to say, how can I lower your tax bill enough today so that I could get you the biggest refund, or lower your tax liability today so you'll hire me again tomorrow, right? That's a lot of what a tax preparer's thought is. But when you're brand new, you don't have an accountant. Today you'll use TurboTax. But a lot of this financial advice comes from, and I saw this recently, so I'm going to steal it. It comes from Marge in HR. And Marge is going to tell you, you need to get enrolled in the 401k plan. Why? Why does Marge want everybody to get enrolled in the 401k plan? And this is the part that nobody talks about. Nobody talks about the other side of the 401k plan, which is the company perspective. The company needs enough participants to make sure it meets the top hat testing requirements. And if you don't have enough of the rank and file that are contributing, then the top executives and the owners that are trying to defer as much as they can't defer the maximum amount. A portion of their distribution is refunded back to them. So they're trying to get as many people of their company to get enrolled and contribute so that they have the most amount of participation, so that the top earners, they can maximize their deductions and deferments. And so
David,
that's the other side of that.
David, that's exactly what the average 401k qualified plan contributor does not understand right there. And that's a little complicated to a degree, but it's not your HR department, your admin. They're not going to talk about that with you. Number one, they don't know that, and it's sad in some in some way you look at it, but at the same time, just what you said, it's what they need, what the company needs. It's to benefit them the same way that it benefits the government. Just kind of really.
But at the same time, Marge and HR thinks that they're trying to help you, and from that belief, they are, but they haven't figured out the end game. That's the thing. And so they're saying, look, you need to take advantage of as much of this free money as possible. This free money, this company match. Is the match matching? That's a whole nother conversation. We might just get into that one. But the only way for you to win is, and if you have a good match, if it's a dollar for dollar match, and here's the way I do it. Turn those dollars into percentages. If they're putting 100% and you're putting 100%, now can you retire at 50% or less so you can keep as much of the company's match in your pocket as opposed to sending that off to the taxman in retirement? So you have to do the match analysis. So if you're getting, and I've seen this before, 10 cents on every dollar of a match, that's not a match, that's an insult. Forget it. There's no way. You might as well not even bother with that one. If the match is 50 cents on the dollar, that's better. But look at that. That's 50 cents per dollar. You have to retire in 33% or less tax bracket. Is that likely?
Well,
and when you look at that tax, the Excel spreadsheet from the IRS, take a look at the history, take a look at our national debt, figure it out. Do you even want to be in a position where you have to make that decision?
Sure. And a lot of employers,
you got a thought.
No, it's good. A lot of employers have actually totally either taken away the match, or they'll only match, maybe 2 or 3% now. Find a 5 or 6% match or anything, God forbid, higher than that is impossible, pretty much. So, most of the time, if employers even offer a match, it's limited to only maybe 2 or 3% in the majority of cases.
Yeah, lately, the matches are generally not as good. So double check. Obviously, we're not telling you don't match, but I'll say double check what your employment is offering. The highest one I once saw was a dollar for dollar match up to 10%. But considering that company doesn't exist anymore, essentially, you got to take that for what it's worth. The higher the match looks, ask yourself, why is that happening? That might be a little more venture capitalist kind of a thing going on. So that's a whole other area.
And back to the what really irritates me, I guess, more about the qualified plan is just how handcuffed you really are. It was kind of in the video there, for X amount of years. You have just tied up everything that you're working for some unknown date out in the future that you actually may or may not even be here. I mean, yeah, there's going to be beneficiaries that get, proceeds from things like that. But once again, we have better products, we have better ways to create not only wealth for you in retirement, but for your loved ones that are beneficiaries on qualified plans and things like that by using products that pay a tax-free, tax-exempt death benefit. So it's just
like we talked about last week. I showed that video of Rodney Balance talking about Roy's story, and Roy, he got himself into a financial pickle, and he had to tap into his qualified plans, which was laid with taxes and penalties. He also had to ask permission, essentially. What that really meant of asking for permission is having what's known as an IRS qualified hardship withdrawal, and you have to qualify for that. And some of it might be good stuff. For example, being a first-time home buyer, you can access your qualified plan and not pay a penalty. Doesn't mean you're tax-free. It just means you don't have to pay a penalty. If you're in danger of eviction, if you have qualified education expenses, there's a litany of other ones. You can always look it up. Or like we talked about in the beginning of the show, which was that like Hurricane Katrina or some other natural disaster, somehow the federal government says, hey, we'll let you access your retirement plan so that you could take care of the things today. These plans shouldn't even be tapped into at all, only because if we compare them to pensions, you couldn't touch a pension. Pension was always shut off to you, but that also meant that it wasn't your money that was put in there. Whereas with a 401k plan, it is a defined contribution plan. It only has money because you put money in and the employer did whatever match it might be. And yet you're locked away from that. And why did we have the credit card debt situations? Because you can't access the money you put. It's a big mess. And a lot of these decisions just aren't well coordinated. And what if there was a way that you could save for retirement and use that money, the same dollars, and put it to work for you for what's important to you? That's available out there. Now, it's not available through your employer. Your employer doesn't know about it. Or if they do, they keep it as an executive benefit plan. It's for the top people. It's not for the rank and file. But there are better ways, I believe, if you want to take better control of your financial future, take better control of your financial decisions.
Yeah, I mean, there's just much better ways to accumulate wealth than traditional planning. It's just we've just been sold a bill of goods, from the consumer has that for the husband and wife that contribute to 401ks, you have better options. If you're currently doing a 401k, contributing to a 401k, take a pause and do some research, reach out to people like us and for some education and advice that you're not going to get from your HR department about the pitfalls, if you will, of contributing to qualified retirement plans.
So here's the other part too, because we're talking about, we're bringing it back around to beginning with the end in mind. And I don't know if we've really talked a lot about the safe withdrawal rate, or rather the fiction of safe withdrawal rates. Safe withdrawal rates aren't necessarily that safe, but here's what's interesting. The studies say you can only take out 2.8% generally. That's the most cited study, 2.8%, and it goes kind of up from there. And yet the government says, nuh-uh, you got to take out 3.5% and increase it from there. And that's what is called the required minimum distribution schedule. And it's funny because, and I say it's funny, not ha-ha, funny like really. You look at the IRS publication 590B, that talks about IRA distributions. And there's a table, uniform lifetime tables on taking your required minimum distributions. And it's listed as a divisor, which you really can't figure that out. You can't wrap your head around it. You just do it each year. But if you look at and how it works, turn those divisors into percentages, it's an increasing percentage each and every year that you're retired. So you might think, gee, if I retire with $5 million, I'm throwing a nice big number out there on purpose. You can start off initially with $250,000 of a distribution the first year, but every year has to go higher. And the reason is because the government created it that way so that they can get their tax monies back at a higher return for the government. They get a higher return for them because they lent you their money so that you could have this big pile of money and that you could call yourself a 401k millionaire, which you aren't. I hate to do the math, but we did the math earlier. You put $1 million into the pension, you cash it all out, and this is what you have left, and it's not so good. But the required minimum distribution schedule is set up so that the government gets their money back based on what they've already lent to you, and again, at an unknown tax bracket. We don't know what's going to happen. And what we also know is that the Trump Tax Cuts and Job Act, the current tax code, is expiring at the end of next year. And I just got an email from NAFA, which is the National Association of Insurance and Financial Advisors. They're talking about it as being the Super Bowl of tax next year, which that's going to depend on who wins the White House election. And just considering yesterday's Trump verdict and everything, who knows what's going to happen. We don't necessarily need to get political, but let's just say if Trump was elected and able to serve and all that stuff, he'll make sure that his Trump Tax Cuts and Jobs Act gets extended. Whoever else goes in probably won't. But I don't think they're going to immediately spike it up to 80%. You know, like Mike said earlier, I don't think they're going to do it that quickly. They've got to do it the way you boil a frog, right? How do you boil a frog? You put the frog in cold water, then you slowly turn it up. You got to do it a little bit over time so people don't feel it. And then once they feel it, it's already too late. You're cooked. Okay, no, I heard that sigh. Okay.
Well, it's just I would say this too about the qualified plans. So many times we just get lulled into being complacent with where we're at, and just like the Tax Cut and the Jobs Act conversation that's going to really surface here in the next few months. Boiling the frog, you're going to get burnt with this, and it's gonna hurt. It's really going to hurt, especially if you are I guess right at the brink of your retirement age, or thinking about it, considering it. It's going to be a painful experience for you that really doesn't have to be that way if you kind of get proactive about it now and look at some different avenues and some of the things that are available to you as far as taking your money out of qualified plans and doing different things. You leave your employer, obviously you can do what you want with it. I run across so many people that have got 3 and 4 401k plans laying around that are still in those plans, and they're no longer employed by the employer, and they just feel like that's the best place for their money to stay. And I'm just like, guys, it's just that's not good. That's not good management of your funds to just have those, with a former employer. There's so many things that can happen with funds after that. I've had people that it took us a year and a half on one to even find the custodian and get the money, sent to the correct, new custodian, just because they'd left it laying around, so to speak, inside that plan. And it's unfortunate, but just be proactive about what's going on within your qualified plans, and look at ways that you can kind of mitigate the tax that you're going to be due and filing on, as these provisions and these rules change in the next year and a half or year, whatever it is we've got left. Just a lot of variables there that you need to consider.
A lot of variables. There are opportunities. That doesn't mean it's not going to be painful, because when we start moving some things over, you're going to pay taxes on the money that's being distributed. So we're not going to say there's a way to eliminate the tax, but would you rather pay it now at a known tax, or at least as much known as possible, than having as much unknown happen later?
Yeah,
at the same time. No, go ahead, Kurt.
Yeah, and no, I was just going to say, I'm currently working with some folks that talking about having access to your 401k. There are ways that if you're still employed, that maybe there's been a contract change or an employment change at your work that gives you an opportunity to really get out of that plan right now. They may offer you a different plan if another employer's coming in, or a contract's being changed. You have an opportunity prior to any age or restriction that you would have normally had under certain employers. So look at all those opportunities that are available to you that you may not think are out there, because you're going to get pushed right back into that situation of the next HR administrator that's going to say, oh yeah, we can roll that right over to, to this plan, and it's a new custodian, but your money's going to roll over, and it's not going to be taxed, and it's it's going to be this and it's going to be that. Those are things that honestly, I feel like they're not qualified to even talk about, that they do talk about. That's kind of one of my beefs with HR departments. They engage in conversation that, to me, is inappropriate to be giving to, you know, employment that they're offering. It's just another avenue that needs to be really looked at hard, from the client perspective, and really from the industry perspective as well.
Oh, granted. So I want to back up, because the first thing I want to think of is that if you have money anywhere, you're doing fine. So
Right.
having money somewhere is better than having no money anywhere. I remember hearing from an industry speech. I guess some lady was killed. Go figure. But so apparently the woman had $3 million in barrels, and the accountant said, "Isn't that dumb? He had 3 million. She had $3 million in barrels." Look, I went home and looked at my barrels. Not a damn dime. You got 3 million anywhere, you're doing fine. But that doesn't mean that it's in the most optimal place possible. And so there are two opportunities, based on age and based on your plan, generally, where you have other options. So the first was, I mentioned it slightly earlier, the age 55 rule. The age 55 rule is that you have to separate from service. You can't work for the company anymore. But you also have to be over age. You have to be 55 and over. And then at that point, you can actually take withdrawals directly from your 401k without a penalty. You don't have to commit to a 72T, which is a way to get equal periodic payments over a period of time that are qualified by the IRS to be exempt for the 10% penalty. But that's one area where you can supplement your income for a little bit. I'm not sure I'd recommend retiring at age 55, but it's another opportunity to take those withdrawals and put it somewhere else. The second one is usually, it's called an in-service distribution. And an in-service distribution is when you can stay at your company, but usually have to be at least age 59 and a half or over. And you can actually roll over a significant portion of that 401k or any other qualified plan they have and move it to an IRA while you're still working for that company. So that's another option. But the plan documents have to allow for that. I know that there's a couple of them out there that they wouldn't let you do that until age 70 and a half. Well, to me, I think that's a violation of that company's fiduciary duties by restricting the opportunities for their participants. But whatever, that's on them. So there are other opportunities, even if you're still working for the company. Maybe there's ways that we can start mitigating some of that and being more proactive now. Yeah, that's all the only thoughts I've got on that right now.
Well, I kind of beat the bush about this right here a lot, but I kind of make a plug for all of us here that advocate for what we advocate for, which is obviously to make people aware of the implications of the decisions they've already made. That's someone we have in our group, that another member of our group that kind of put that out there, and it's so true. I mean, there's so many unknowns, but whatever you're doing, you need to be aware of what those consequences are. But if you're in a qualified plan and you are unsure of the opportunity that you may or may not have to, whether it be to maybe only fund it to the match and do something outside of the match, or maybe that there is an opportunity that you're under 59 and a half, but you've had a employer change or something that gives you an opportunity to pay that tax in the most efficient way to get out of that plan. Take a look at those ways to do that, because I think I'm going to get this right. And if I'm not, I'm sure David, you'll have the correct verbiage to correct me. But we have a proven way that we can show you how, somewhere around the 6% number, that we can use that over like a 10-year period to pay all the taxes on qualified dollars, get them out of that qualified bucket into a tax exempt status over that 10-year period. So if you're in a situation where you can possibly look at doing that, by all means, reach out to one of us and let us educate you. We're not going to try to sell you on that. We're just going to educate you on that and let you make that decision to see if that's an avenue that you want to explore further or not. But so much is dependent on how much you're going to be taxed in your retirement. I think that you owe it to yourself to find out the pros and cons of each. And retiring in a lower tax bracket is not the answer to a successful retirement.
Yeah, if we could actually help our clients to actually have cash flow that doesn't even have to be reported legally using the tax code. Again, I'm not going to jail for anybody. I want to help people retire with as much income off the radar screen of the IRS for income tax purposes. If we can help do that, I think we could be heroes to the American public. And the time to understand this has never been more urgent than these days, especially with articles, especially earlier this year, that we're reaching a breaking point regarding our national debt, and that more and more of our debt that's accumulated is more of interest on that debt more than spending of anything else. We're getting to a breaking point. And the thing is that who's going to end up paying for that? The government does not create a product. Unlike Dubai. Dubai has their own country's product. It's oil. Great for them. We don't have that. And because we don't have that, the American people is the GDP. The American people are the ones that pay all that in there. And that's why we get so upset when taxes go up. Like, where's our money going to? Oh, boy. It's a whole other rant.
It is. And to your point earlier, Mike, where you made mention of the day and the month and the year that you retire, and look at the state that you retire in. I mean, you're in one of the higher, both of you guys are in one of the highest tax states in the union. And, Mike, you can probably speak to that locally at people you talk with and meet with about, what kind of impact taxes has, it has on their retirement and anything that they do, anything they do that involves money in the state of Illinois.
Well, that's true. I mean, so just to touch on what you just said, most of the time we only talk about taxes on a federal level. We haven't even touched on taxes at a local or a state level. So
yeah, and like for instance in California, what is it, David? I mean, any state you can be, you want to pay paid first, or you want to pay fifth, sixth, or I think there's even a seventh tax that's in a portion of California. Is that correct?
Well, yeah. Well, it could even be eighth as far as I know. But the thing about California, look, we've got good American citizens, and many of them believe, and it's true, it's our patriotic duty to pay our taxes. And and again, I'm not telling anybody to not pay your taxes. If you've incurred a tax that needs to be paid, you got to pay it. But noticing what is the rate of return of life on the money that's being spent and sent to our government. And quite frankly, we can make far more impact by saying, do you want to continue to support Governor Gavin Newsom's economic policy? How well has that been working out for us? Do you want to put your wealth in a position where those people have a say of how much your retirement wealth gets spent and is for their agenda? My God, you put it that way, and people are going to be rising up in arms. Granted, people rise up in arms probably just because of yesterday's news. Again, this is Trump's felony trial, and he was found guilty. But still, we're looking at the government. Who's behind the spending? When we put names to it, and we feel like we want to actually get to real accountability, you can hold them accountable by where your retirement dollars are, and you can begin to siphon it out using the tax code, using all the provisions to put it to somewhere where it may never be taxed. You say, you guys effed up on enough of my money. I'm not sending you anymore. And I'm making sure that you can't touch the money based on the tax code. Now, the next question that will come up is, well, how do I know that they can't touch what you guys are talking about? Right? Because that's the next thing. How do I know that where we're putting the money to will still be safe and secured? And the reason is because the last time they touched the taxation on life insurance and annuities was back in the 80s, and they finalized it back up in 1986 and there's 3 laws. I don't remember the acronyms, but TAMRA, TEFRA, and DEFRA. And all of them all the contracts that were enacted through a given date were all grandfathered under old rules. And that's the difference between a contract and an account. A contract has a beginning date. It has provisions. It's all protected by federal and state laws. And because of that, all of the rules and taxation, everything is based on the contract date. Whereas with an account or an arrangement, it's all based on whatever it is now and your age, and those provisions in the tax code based on age. So, that's why, the age 59 and a half or age 62, 65, whatever it is, all those different ages affect your accounts or your arrangements, as we should more accurately call them. Whereas contracts, they're grandfathered based on the time that the contracts are put in place. So, and that's based on past precedent. We didn't make that up. It's already been done before.
Yeah, I mean, really, when you think about it, back to common sense. I mean, why would you want to be involved with the government in an arrangement that there's so many unknowns? I mean, it just stop and think hard about what you're doing, whether it be with qualified plans or anything that's government involved. Doesn't matter which side of the aisle you're on. Has nothing at all to do with that. Yeah, there's some that are on certain side that are going to advocate more passionately, more strongly for one way or the other. But as a whole, it's up to you to be your own best advocate for what you're currently doing.
Absolutely. And by the way, my rant against Newsom was primarily because of his results. The guy's a dynamic guy. The problem is he's only serving himself, as far as I can tell, because we got homelessness going up the wazoo. Taxes are at the highest amount. Sending more money to the government to solve a problem has not been the solution. Now, that doesn't mean I know what the solution is, but do I want to keep funding a failed plan?
Well, yeah, and we could go on, and it'd be a 4-hour podcast if we got to talking about unfunded liabilities and things that are going to have to be, funded in order for the government to stay on track and really our country to stay on track. And that gets back to the taxation of, where are they going to get this? Where are they going to get this money from? They're going to get it in some form of taxation. And I would think there's about a 99.9% chance that is going to come from people like, that contribute to qualified plans. They're going to have to come up with a way to recoup a portion of funds that they need to fund some of those liabilities.
There's more correlations there than we realize, because as we look at the national debt growing and we see how much the stock market grows and how much of the stock market is invested in these qualified plans, the whole thing is interrelated. So we can see a whole lot of patterns there. Question is, do we want to be part of that or not? And I'm more of an advocate to show you, here's what's going on. Do you want to be a part of that or not? And if not, how can we do it with the least amount of pain to make that transition so you could be the primary beneficiary of your life's work and of your financial planning? You did everything right. Why put it to people that can't be held accountable for what they're trying to do? And quite frankly, hold them accountable by where you put your dollars.
Exactly. Well done.
All right, Joe, I think enough of a rant was there. I didn't expect to go down that route, but there it is. We're going to catch you guys next week. I don't know what we're going to talk about next week, but that'll be next week. So thanks so much. And we'll see you all next week here on YouTube, Facebook, and LinkedIn. All right.